Hello, everybody. Luke Gromen, FFTT. Hope you are well and having a great start to the week. I'm going to use my handy dandy little applause button here. That's fun, right? Okay. We're going to jump right in. Thank you, as always, for the questions. Really appreciate the feedback and the back and forth. Always very thought-provoking. So with that, I am going to jump right in. From Scooney, Luke, what is the highest probability triggers for a sudden risk-off event? It's a bond market problem. Watch JGBs, Japanese government bonds. Watch UK gilts. Both are highly correlated with U.S. Treasuries, particularly at the 10-year duration. And if 10-year treasuries go above 4.6% to maybe 4.8% in the U.S., we've seen repeatedly that'll drive a sell-off in U.S. stocks and pretty much everything else other than maybe the dollar and gold. And it would ultimately, what we're seeing in these bond markets, U.S., but more importantly for the moment, Japan and UK, is a choice. You got to sacrifice your currency or you got to sacrifice your bond market. In our view, really the base underpinning of our view, why gold and Bitcoin are trading where they're trading, is they always choose sacrifice the currency. Why? Simple. Because if they sacrifice the bond market and let rates just go up and up and up, given their debt levels, they ultimately end up sacrificing both the currency and the bond market, because higher rates drives receipts down and interest up, and that means interest quickly goes above your receipts. And when that happens, that drives essentially hyperinflation of the currency. Either they can't pay the bonds and the bonds back the currency, or more likely they print the money just to pay the interest, and that drives a version of hyperinflation. So they always choose sacrifice the currency over sacrifice the bond market when debt levels are high as they are. And that's why, because the sacrificing the bond market only buys them a little bit of time, and they ultimately end up sacrificing both. So from GH, what is your take on gold-backed bonds via Judy Shelton? I think it is a very effective way, or certainly would be, to lower interest rates. There are two components to bond risk: default risk, i.e. they don't pay you back, and inflation risk. They pay you back, but with devalued dollars. Since we're talking about the sovereign bonds of the United States, treasuries have no default risk. They can always print the paper to give you what you are owed, even if that paper were in extremis worth zero. Now, that means all the risk on treasuries is inflation risk. And the gold component, as proposed by Judy Shelton, would significantly reduce the inflation risk, because it reduces the interest rate that would be needed, because the gold is would rise to compensate you in the case of inflation risk. And so in theory, with a gold-backed bond, you could cut interest rates as much as Trump is talking about cutting them. Obviously, that would make the debt much more sustainable. In my opinion, doing this would require a much higher price of gold. And I would also add that the Bit bond idea, using Bitcoin to do the same thing that has been floated, it has the same dynamics to it in terms of the outcomes and why it would lower U.S. borrowing costs. From Mike, Luke, do you see gold eventually overtaking the U.S. dollar as the world's reserve currency like it did the euro? Thanks. A minor clarification, I would say it's the biggest asset in FX reserves. Overtake the dollar as biggest asset in FX reserves. Yes, I think 100% that's going to happen. 99% that's going to happen. I can't be certain of anything. For those that didn't see, we had on our X, and there were a number of articles around it a couple weeks ago. The ECB pointed out that when you include gold into global FX reserves, the dollar is now 46%, below 50% of global FX reserves. Gold is now 20%. The euro, 16%. Another few years of 1,000 ton plus per year central bank gold purchases. Give it another 30 to 40% increase total over that time in gold prices, and you're probably going to be getting gold reserves in FX reserves pretty close to parity with dollar reserves. And critically, every policy being pursued by the U.S. and the BRICS is pushing things in that direction. Weaponization of the dollar, weaponization of FX reserves, fiscal on the US side, fiscal globally, de-dollarizing global commodity markets by the BRICS, heightened tensions between the US and China and Russia. It's all moving in that direction. So I would fully expect within 5 years gold to be back to where it once sat, the number one reserve asset in FX reserves. Whether you want to call that gold surpassing the dollar as reserve status is a personal preference. There would be certainly some validity to using those words. From Michael Barnes, subscriber, and thank you, Michael. Appreciate you. Your recent newsletter referenced the book Lords of Finance. Its author noted that a century ago, the Great Depression and markets crashes were partially exacerbated by the fixed currency peg to gold, particularly the British pound. If that is correct, then one, do you believe there has existed a soft peg or cap of the dollar to gold? Yes, I do. Two, is that policy unsustainable? Yes, it is. Similar to the gold peg of the late 1920s or early 1930s. Three, is that soft or range-bound peg now unwinding? Yes, it is. And four, if it were to happen, how would a chaotic unwind actually play out over a few weeks or months? Great question. Gold has been capped by the expansion of unallocated paper derivatives centered in London. It was done to keep gold too volatile to be used as an FX reserve, and more importantly, structurally too small, so that ultimately treasuries would gain dominance as primary global FX reserve in the manner described in the prior answer. That policy was always unsustainable, but it worked, particularly if you look at gold, how it traded from, call it, 1986 through 2002, 2003. That's what was going on. And ultimately, it's breaking down, and it's being broken down over the last 10 to 12 years by China doing what we call here in the U.S. as calling bullshit on the price of gold. Basically, China said, oh, you're saying that's the price of gold, and you're keeping it there with the expansion of paper derivatives from 20 ounces of paper per real ounce to 50 to 100 to whatever. Great, we'll take the underlying physical ounce. Great, we'll take that one too, and that one, and that one, and that one. And importantly, they have paired it with their own factory output. They're running a surplus to the world. They're the factory of the world. And they paired it with marginal yuan oil pricing from Russia and Iran. No small surprise that Russia and Iran are part of the axis of evil now. So when you pair yuan oil and commodity pricing with Chinese factories, surpluses, that's what's unwinding all of this. And the evidence of this, you can see the footprints in the market if you know what you're looking for. The gold to oil ratio, when they started doing this, when it started really by Putin starting to shift reserves into gold in 2008, the gold to oil ratio was 8 barrels per ounce. In other words, it took 8 barrels of oil to buy 1 ounce of gold in 2008. Today, that's 50 barrels. The price of gold has gone from 8 to 50 in terms of barrels of oil. That's very good performance. It's also shown up in the rising yuan price of gold because, again, China pays you in yuan, you recycle some into Chinese goods, and you put the rest in gold. Gold, yuan for gold. The price of yuan gold has gone from 7,000 yuan in 2014 when they opened the Shanghai Gold International Board, reopened the gold window without Washington's permission. It's now 24,000 yuan. The yuan, everyone's waiting for the yuan to collapse. The yuan's collapsed already. It's gone from 7,000 to 24,000 against gold. It's just not collapsing against the dollar. Now, this is also forcing the U.S. government to either try to keep capping gold, along with the Brits have had a hand in it. That ultimately leads to more losses of physical gold out of London. You can only lose so much. Eventually, you go to zero. And that also results in the dollar being too strong against the Chinese yuan, which is a direct contravention to everything we're trying to do and helps the Chinese outcompete us everywhere else in the world. Both of those things are very bad for the U.S. very quickly. On the other side, if the U.S. begins to shift to a more gold-based system, basically ceding control, basically ceding that the once and future primary reserve asset of the global system is gold, not treasuries, that's ultimately much better for the United States. It rebalances our economy. It allows us to reinvest in domestic production and defense and infrastructure. It's a great, great thing. And it also results in the loss of hegemonic power of printing over time, at least at the extent that we can currently do so. So it's not my base case, but you asked about a chaotic unwind or a quick unwind. That could be done quickly. Cash settlement of paper gold claims of all stripes. In other words, if it ain't in your hand, you don't own it. And Friday night, it's trading at 3,300. Market closes. Sunday night, all cash, all paper claims settled at 3,300 per ounce. Sunday night in Asia, gold opens at 12,000. Physical only. Have a good day. You haven't lost any money, but you've had a big opportunity cost. That's why I think if you want to own gold. And that's how I think they could do it in a relatively short order. So great question. Appreciate it. And hopefully it gives people something to think about. From Atwell. Hi, Luke. Very happy long-term FFTT subscriber. Thank you very much, Atwell. I appreciate you. Right now, markets are at all-time highs and very easy credit conditions, low move volatility index. What are the chances the U.S. administration can take another chance to achieve what they missed after the April 2nd rout? In my opinion, the odds are very, very low that they can do that. The plan A, remember, this was plan A. Everyone was telling me plan A. They're going to take pain. Besant, we're going to take pain. We're going to move stocks into bonds. People are going to sell stocks to buy long-term treasuries. And then we're going to doge cost cuts, and the yields are going to come down more. And then we're going to term out long-term debt. We're going to term out debt into long-term treasuries. And we'll have restructured, and then we'll go from there. And that plan failed miserably on every count. Why? Because there's too much debt. There's too much debt. That's why I told them over and over and over and over, as you all know, ad nauseum. You got to devalue debt to GDP first, or otherwise it's going to blow up in your face. They didn't. It blew up in their face. Here we are. Nothing's changed on that front. They haven't devalued the debt. It will blow up in their face again, rapidly. And I think when you see Besant go from, we're going to take pain and there's Doge and we're going to term out the debt to we're going to grow the economy faster than the rate on the debt. Plan B has started, and it sounds an awful lot like FFTT Plan A. I think that's what the plan is. I think financial repression, big deficits, a version of yield curve control, maybe using stable coins. Pay attention to what Besant's saying on that, especially now that the administration appears to understand the leverage that China has on rare earths, which is astonishing to me that they didn't ahead of time. But I think this has, again, been evidenced by Besant's tone. If you remember, Besant went on Tucker Carlson, did an interview with him April 7th, said, we have all the leverage. We're the debtor in the relationship. We have all the leverage, not the creditor China. Last week, Besant went on CNBC and said, we are negotiating with the Chinese with mutual respect. Those are literally verbatim the words that the Chinese said. We're not talking to the Americans until they deal with us with mutual respect. Tells you what's happened behind the scenes, folks, if you're paying attention. So, no, I think ultimately we're in a much more Bidenomic-like environment of big spending, high growth, somehow keep rates below the rate of growth, and weaken the dollar. From Zachariah, if financial repression is likely to occur and retirement accounts are government controlled, does it even make sense to contribute to them? In my opinion, yes, and I absolutely do on a multiple of fronts, because you can make choices within those vehicles, which tend to be tax favorable in the meantime, that can benefit you and position you for a financial repression type environment. If it's not an all or one, all or nothing type of environment, which it probably is likely to be. Yes, we'll have financial repression, but that doesn't mean we need to go full authoritarian draconian outcomes per se. And because nobody knows the timing, maybe we do go full draconian outcomes, and maybe it's 30 years from now. Or 40 years from now. And nobody really knows the path of these things. So I think you want to have a hedge against the math taking longer to play out. So you just want to be also overweight somewhat what Zoltan Pozar calls outside money, right? Money outside the system. Gold, Bitcoin, maybe some land, fully owned. Next question from TD. Please repeat simple explanation how gold rise is a deleveraging of the dollar system. I mean the discussion on the thread with George Gammon about dismissing milkshake theory. It wasn't a dismissal of milkshake theory, just a portion of it. Gold rising is a dollar devaluation. Don't let anyone else kid you. That's what it is. Gold is being driven higher versus oil, as I just discussed, versus the yuan by Chinese and Russian de-dollarization efforts, which use gold as their neutral reserve asset. People keep saying, oh, the Chinese don't have a big enough bond market. They don't want to do that. They don't want to sell their bonds for stuff. They are not trying to replicate the dollar system. They are trying to replicate the system of where dollars were good for gold, but they're not making the same mistake of pegging the yuan to gold. That's stupid. No one would do that. They're letting yuan float against gold. That's why the price of gold in yuan has doubled in the last 2 years, because they're using gold as a neutral reserve asset. Central banks, for their part, within all this, they haven't added to their treasury holdings in 11 years. 11 years. They're not buying dollars anymore. Full stop. You can see it on every chart. Check out my feed. What are they buying? Gold. They're buying gold, which is going up in price. Chinese citizens have been told by their country, buy gold for the last 23 years. They own a lot of gold. Chinese commercial banks own gold. So the gold price goes up enough, bid there by real trade and of the global economy, Russian commodities, Chinese factories and surpluses, OPEC, and those with gold holdings are delevered relative to their dollar obligations. Like I said, this doesn't invalidate the milkshake. It does invalidate part of the milkshake view that the only way to deleverage the milkshake is with the dollar going to some gigantic number. No, it can happen with gold going to a gigantic number. Tom, how deflationary is AI going to be? And paired with that, Tracy, do economists consider demographics sufficiently? I think they were a related question for our times today. AI could be highly deflationary. I lived through a version of a productivity boom here in the Rust Belt in the U.S. for U.S. manufacturing and working class workers. Their jobs and their factories were sent to China in 2001 through 2010. AI is quite possibly the exact same thing, except for white-collar workers. And so as white-collar workers start to default on their mortgages and consumer loans, that quickly puts banks at risk. But the banks, guess what they have as high-quality liquid assets, as capital, to sell to offset loan losses in their reserves. They own treasuries. So we saw a small version of this in 1Q23. Remember Silicon Valley and Signature Bank? Do you remember the part where they were having a banking crisis and treasury yields were going up? Why? Because the banks were selling their treasury holdings to raise money to pay out depositors? Yeah. Same thing would happen. You would AI, if it drives a big enough unemployment, deflationary unemployment for white-collar workers, which I think it might in the next few years, banks are going to start having loan losses, and they're going to sell treasuries to offset them. And when they do, you're going to have a recession in the U.S. where treasury yields go up, quite possibly, after maybe a brief decline in treasury yields, but they're going to end up going up. And so then the question becomes, will the Fed stand aside and let tax receipts of the U.S. fall in a recession while treasury yields go up? That's a death spiral for the United States at current debt levels. And we have an answer. 1Q23, they sure didn't let it last long, did they? Week or two in, BTFP, buy the effing paper, or bank term funding, whatever the heck it stood for. But the punchline was this. It was yield curve control for U.S. banks via swap line. Treasury is trading at 70 cents. The Fed came in and said, we'll give you $1. We'll pay it par on it. We'll swap it for that and maintain liquidity. That's all it was. So the Fed papered over it then. So the question on is AI deflationary you need to ask is, will the Fed, initially, sure. But do you really think the Fed's going to stand aside and let the banking system fail because AI is so deflationary? Come on. Really? They papered over, importantly, look, the Rust Belt deflationary, it was papered over with some prime, right? You go making $30 an hour, full benefits at Ford, to making $12 an hour at Walmart as a greeter, no benefits, but Goldman Sachs gives you a subprime loan. You can buy a bass boat, you can buy a truck, and away you go. And it's all good as long as your home price goes up 10, 15% every year. 2005, home prices stopped going up. You know what happened next? All those subprime loans, in one form or another, de facto ended up being put on the Fed's balance sheet, which went from $800 billion in 2008 to $4.6 trillion by the time all was said and done in 2014. So There's no subprime being handed out to white collar workers. Yeah, maybe. Watch for that. But I'm not sure the private credit markets are in a position to do that anyway. So ultimately, I think the Fed is going to have to help bail out the banks as a result of AI deflation whenever it sets in. If it sets in, which I think it's going to. And so that's why I continue to believe the best chicken plays for AI are Bitcoin and gold. Because AI, if it does even close to what people are saying it could do over the next 5-10 years, the Fed's going to have to fully reserve consumer loan debt, treasury market, and then the bond market at large. And when I mean fully reserve, I mean put it on their balance sheet, print money, buy it off, they buy the impaired debt off of banks and off of others. We know what that did for gold and Bitcoin. Okay. Demographics, related question from Tracy. Yes, I do think economists are not considering demographics sufficiently now. Or maybe more accurate, they're only considering them sufficiently in one direction. It is near religious dogma in the economics profession that positive demographic growth is positive and a requisite for economic growth, GDP, etc. Okay. But what if AI takes away jobs? What if it takes away meaning for a lot of people? I can tell you, I've been to enough of the funerals. Since 2010 to 2022, we had 1 million Americans dead of drug overdoses as they lost meaning, as their jobs were shipped overseas. They were called deaths of economic hopelessness by the Wall Street Journal in 2015 in a study by Case and Deaton. That's what Chinese offshoring did to U.S. manufacturing, what AI is conceivably going to do to a lot of white-collar people. Now, the other issue and within all this is, you know who has got arguably the best demographics in the world? The Mideast and Africa. But if you've got great demographics and no opportunity, no meaning, you have no political stability, do you? So I think when I say that economists are not considering demographics or they're only considering in one direction, they're talking about all this productivity growth on one side from AI, but they're not talking about who's actually going to have political stability or instability if you don't find meaning when your job is replaced by AI. What are you going to do? What is it? Does it have meaning? And it's entirely possible that the Asian nations that we're all pointing to as being long-term screwed, for lack of a better word, because of their demographics, Japan, South Korea, China, might actually have the ideal demographics for AI. That's what I don't think economists are thinking about. And I think there's a whole number of reasons they're thinking about it that way. But luckily, I am living in Cleveland and uncouth. And quite frankly, I've been to enough funerals from where loss of meaning was at least a tiny factor. And so I'm going to talk about it. So at any rate, that is unfortunately a bit of a dour note to finish up on, which I don't always like to do, but I appreciate all the questions. I appreciate you joining me. As always, if you like these updates, check out FFTT-LLC.com for more information. But our Tree Rings product, 10 most interesting things, brief synopsis about what grabbed our attention about them, and whether it's either changing or reinforcing a way we'd previously been thinking about the world. And as always, how you can make some money with it is that's what we're trying to do is grow our wealth over time. So thank you very much. Everybody have a great rest of your week. We'll talk with you soon. Take care, everyone.